Banks are special, banks are different. Anyone that looks into banking and NBFC with the mindset of a manufacturing organization is missing the point. This section is to make sure that you don't miss the point. We now look at specific issues relevant to banks and NBFCs, and these might be issues that are not necessarily within the remit or covered by BRSR or SEBI. But once we are into sustainability reporting and we are considering the sector, it's worth looking at features which are unique to this sector. So the first thing is the global expectation is that the banks should prefer funding green rather than grey. Now, this is not a focus of SEBI and BRSR. But yes, the banking regulator, Reserve Bank of India, will and does have something to say about this, but it's worth bearing in mind that the BRSR does not address this one issue. The second issue is what's called financed emissions. The quantity of emissions by all the borrowers of the bank divided by the total amount of loan that the bank has given gives the emissions per rupee of loan given per dollar of loan given. That is a metric that certain global initiatives want to drive down. Banks are expected to ask their customers to bring down the emissions so that this number, emissions by loans, comes down. It is one version of the first step, which is to fund green rather than grey. But if you are funding grayer sectors, are your customers that are borrowing from you planning something to bring down emissions so that over a period of time, the bank will be able to report lower financed emissions? You're going to lower it either by going more green than grey. You're going to lower it by your grey customers bringing down their emissions. This too is not a focus area in BRSR and falls with RBI. Then, stranded assets. From a risk perspective, banks can end up losing a lot of money if a sector it has lent to dies because of environmental preferences. And a leading Indian example is leather processing units along the banks of Yamuna in Kanpur were ordered shut. And the banks that lent to those units might have lost all the money that they lent if the leather company became insolvent because they were just asked to shut down. That is an example of a stranded asset. So any business that does not have a future in a greener earth might well die, and a bank funding it might lose all that money as well. Which brings us to a larger issue of climate risks. Climate risks are easily understood, simply understood. Again, we have something specific on climate risk. For the more interested person, look in the description for that. But climate risks, simply understood, events caused by changes in the Earth's climate-related variables. What are those variables? Rain, temperature, flooding, and so on and so forth. A closer look at climate risks shows that there are two types there: those that cause destruction, like a storm or a flood, or those that are more permanent in nature, like increase in the salinity of the ocean, or change in the acidity of the ocean, or change in currents of air, which might not reverse. The BRSR does not specifically cover climate. It uses the word sustainability in multiple places. In this piece, we must specifically focus on how climate risk relates to banking and non-bank finance companies. For that limited purpose, let us just stay with a simplified expression of climate risk. A factory being destroyed by an unexpected flood or storm is a climate risk. Expected flood, just to be very clear about this, If a factory is located where a flood is expected or a storm is expected, that's the wrong place to put it. Even if there is insurance, that's the wrong place to put it. This is an obvious factor with a manufacturing company. So if a manufacturing company had a plant somewhere on a coast where occasionally cyclones happen, and now because of climate risk, the incidents of cyclone have increased. But how does this get considered at a bank? At a bank, the location of the customer's properties, are those locations particularly vulnerable to climate related events? Does the bank know this about its customers? Does it document it? Does it feature at the bank? Loans. Can a bank's loan exposure get wiped out by a climate event like the leather unit in Kanpur example? Insurance. When a climate event occurs, is that covered by insurance? At what cost is cover available? It's useful to understand the attitude to insurance. If it is unexpected, one should insure for it. But more often than not, people that have property in desert like areas tend not to take flood insurance. Whereas that is exactly where you need insurance for the unanticipated. And because floods don't occur so frequently in a desert, the cost will be lower. You have to cover the unanticipated, and for the anticipated, you're supposed to operate with common sense. And furthermore, if a factory is disrupted from a climate risk, is there a consequential loss insurance cover that compensates the company for the non operation of its factory due to an insured risk? Is that an issue banks assess on a running basis? And then, if it is insured, then there is every possibility that the bank is able to recover the cost of a physical asset that it has financed from insurance. But oftentimes banks give loans based on the future earning capacity of an organization. And if that future earning capacity is destroyed, what happens to the loan? Consequential loss insurance is not available beyond a certain period of time, maybe 3 months, 6 months, maybe a year. But banks consider cash flows of 3 to 5 years as well in giving an industrial concern a loan. All these things can blow out the balance sheet of a bank. These are issues that banks will definitely consider, and the banking regulator RBI will be keen to know how banks are exposed to climate risks and how they plan to fortify their balance sheet against the kind of scenarios I have described. In BRSR, the reference may be seen as indirect. Indirectly where? Please look at section A7 on transparency and disclosures. It covers the section titled Overview of the entity's material responsible business conduct issues. Climates are a material risk to banks as per global practices. Bank for international settlements, which banks and regulators typically follow, covers exactly the kind of issues that we have discussed in this special section for banking.